Thank you. I'd like to get started, please. Good morning. Hope the trading's going well. I've been sending you some emails on the cotton market, some surprises with regard to China's lower than expected production. Also, there's been a lot of activity in the currency markets and the financial markets with regard to economic news. I want you to start thinking about the relevance of that material because we'll start on Chapter 4 actually today. And so there'll be some more information with regard to how these economic indicators impact the currencies and most of the financials, basically the interest rate. So today I'd like to finish Chapter 3, and I'll actually start on Chapter 4 today. Before we do that, hopefully you can read this. I'll put the lights on. With regard to next week, the midterm's on Friday. So Montish has kindly agreed to have a review session on Thursday late afternoon, right, 5 to 7 p.m. Temporary classroom number 3, 5 to 7 p.m. on Thursday. Right? Her office hours are listed here. I have a slight change in my office hours next week. Yesterday I sat there for 2 hours and I felt like the lonely Maytag salesman. Nobody came. It was very lonely. Anyway, next week, office hours for me, 2:30 to 4 on Monday, 1 to 3 on Tuesday. I will not be here on Thursday, but Montish is having the review session for 2 hours, so that should be very helpful. You should really go to that review session to help prepare for the exam on Friday. Okay? Yes? I was going to say over by the hog barns, but I think the hogs are gone. Oh, over by Meyer Hall, is that right? That way. Yeah. I don't know. You have to look on the map. They're little trailer, portable classrooms, basically, right? Okay. I'm sorry. I was there once a couple years ago, but do you know where Meyer Hall is? That general direction, over by those new engineering buildings. It's in that general area, okay? Okay, so like I say, I'd like to finish Chapter 3 today. We discussed the theory of price of storage, and I want to complete that. And to introduce you to Chapter 4, actually I have about a 20-minute video on foreign currencies. That's a very interesting part of the market right now. There's a lot of activity going on. I've been holding Canadian dollars all summer, and finally it's moving. It's moved about 20% just in the last few months. Basically, the US dollar is going down. And so this video will talk about the foreign currency market. And when I roll the video, watch for a gentleman on there. His name is Jim Rogers. I'll talk about Jim later. He's written a wonderful book called The Investment Biker. A couple years ago, he bought a motorcycle, traveled around the world, and wrote this wonderful book about investment opportunities in different countries. And it's just a wonderful read. During the millennium, he was getting a bit older. He traded the motorcycle in for a souped-up BMW. And he actually also found a younger traveling partner. And he went around the world again in this car. And with the new technology and satellites, he had a website so you could track him. And he's just written a new book, which I haven't ordered yet. And you'll see him a lot on CNBC, and he's really high on currencies right now, Jim Rogers. And he has a great website, www.jimrogers.com. Okay, on Wednesday, I derived the demand for storage. There was total silence in the classroom. I suspect you haven't read Chapter 3, but this is important. So hopefully some of you have read it in the meantime. We started with a simple inverse demand curve, price is a function of consumption. We substituted in an identity for consumption, and period T is equal to incoming stocks plus production minus outgoing stocks. And then we were interested in the intertemporal spread, PT plus 1 minus PT. That's what we see in the futures market when we look at the March-December futures. We're interested in that spread. And Holbrook Working said that spread depends on the demand and supply of storage. So we derived this demand curve, and we found that it was downward sloping, and we sort of confirmed the intuition there by just asking a little question. Suppose the carryout stocks, S sub t, that's the amount of stocks that are carried from this period to the next. Suppose the amount of carryout stocks falls, so we go in this direction to the left. What happens to price in period t? Well, that means that carryout stocks are going down, more is pushed on the market in period t, pt falls, less is carried forward, so pt plus 1 rises, so the spread would widen. So it makes sense that this demand curve is downward sloping. And then I explained that the demand curve actually moves around. And I gave you this example of a shift in the demand curve rightward and what factors would cause that to move right. Remember that this is the demand for storage. In the marketplace, there are certain economic actors who have a demand for inventory carried forward. And if you think of the heating oil example, there's some news about the heating oil in the Wall Street this week. People that demand storage of heating oil, the primary demand comes from the homeowners and the businesses that use the heating oil to heat their properties, and that's funneled through wholesalers who supply the product, the heating oil product. But in all likelihood, they're not the ones that carry the inventories. The inventories would be carried likely by oil companies or large merchants, and so the demand for the inventories is derived from the requirements next period, and the supply comes from somebody else. So that demand will shift right if there's an increase in production this period, xt goes up. If there's a fall in expected production next period, so as we go into the winter months, you could think of t plus 1 as being winter, and t is the current period. If we expect the supply of heating oil to fall in the winter because there's going to be a series of storms in the Gulf that will affect refineries, let's say in the Gulf of Mexico, if that's the case, then demand for storage would shift to the right because the market would say we need to bring more into the winter. We're going to have a decline in production in the winter. Or if there's an increase in stocks carried out of t plus 1, that would all contribute to a rightward shift in the demand. The demand will shift left if we just reversed all those examples I just gave you, right? If there's a fall in production this period, well, there's less commodity around, so the demand for inventories to be carried forward falls. And I've just reversed the signs on production next period and carry out stocks next period. So we know the shape of the demand curve, and the important thing to remember is that it shifts around. And now we come to the supply side, okay? And the supply curve is down here. This is the final curve that we're interested in, and it has sort of an odd shape, and I'll try and explain where that shape comes from. Well, the supply curve is made up of the three components I talked about initially. You have physical costs, you have risk factor, and you have marginal convenience yield, which I explained was actually a negative cost, right? We talked about somebody walking around with $200 in their pocket. The reason they do that is because there's a yield associated with holding physical stocks. So let's start with this component, which is the marginal physical cost of storage. So the supply of storage really represents the marginal cost of providing stocks, right? From economics 1A, 100A, you know that the supply curve is the marginal cost curve. Well, it turns out that the supply of inventories is made up of these three main components. You have the physical cost of storage, and we're interested in the marginal physical costs. The more stocks that are held, eventually the marginal costs increase. They're flat for a while because you have a certain warehouse space, or if we're carrying heating oil or crude oil, we have a certain capacity, and as we add stocks, we're not bumping up to our capacity, so the marginal cost is pretty constant for a while. Once we start to hit that capacity, then the marginal cost will begin to rise. So this includes such things as insurance, the fact that there's an opportunity cost associated with the money that's invested in the physical inventory, maintaining the warehouse, etc. All those physical costs are part of providing storage. In addition to that, we have what we call a risk aversion factor, which is really associated with the fact that merchants who carry inventories are risk averse, and the more inventories they have, the greater risk they run, right? A warehouse could explode and blow up. It happens. A storage facility for oil could catch on fire. It happens. Things happen. As a result, there's a risk component, and they must be paid for incurring that risk, right? It's just like the speculators incurring risk in the market when they buy contracts. The hedgers must pay them for that. So if I'm willing to maintain my warehouse and carry stocks of cotton, or maintain my storage facility and carry stocks of heating oil, then I'm incurring a risk, and I want to be paid for that. So the marginal risk, again, is low for low levels of stocks, but as we increase the volume, then at the margin, the cost factor increases at an increasing rate. Then we have marginal convenience yield, and we spent some time discussing that on Wednesday. Keep in mind that this is a negative cost, and I gave the example of Anheuser-Busch, which I don't know if you found interesting or not, but the reason they carry stocks is because basically they don't want to run out of barley. If they run out of barley, they can't make beer. And you watch the ad on the weekend, you drive down the store, there's no Budweiser, you're going to be angry, right? And you'll never look for Bud again. So that's why they carry stocks. They don't want to run out. It's very typical in the processing sector to carry what's referred to as, quotes, pipeline stocks. You carry enough inventory to keep your plant running for maybe 3 weeks. Certainly you don't carry enough inventory to keep it running for a year like Anheuser does, but they're in a different situation. So a lot of processing firms, and it doesn't matter if you're processing cotton, you're processing lumber, you're processing oil, doesn't really matter. They will not operate with inventories that will only keep them going for 1 or 2 days. It's just too risky, because if they run out of inventories, there's a transportation disruption or some other factor, then they have to shut the plant down. The startup costs are high. And so they carry stocks that provide a yield. It's a convenience yield. As I said, the analogy was we don't keep all of our money in the bank. We keep some in our pocket because there's convenience associated with having access to a small amount. And so when stocks are low, for low levels of stocks, that convenience yield is very high, right? So if you have $20 in your pocket, adding another 5, so there's certain marginal yield associated with that. You know, maybe $25 will get you through the weekend. So that extra $5 adds a certain marginal convenience. Now, if you increase that to 100, well, the last 5 that you add doesn't add as much marginal convenience as going from 20 to 25 as from 95 to 100. So you get the rough idea, right? If you have enough stocks to get you through, to keep your plant running for a month, well, the stocks that keep you running the first week are actually more valuable at the margin than for the second week, and so on. So the marginal convenience yield will fall as you add stocks, right? If you only need stocks to keep your plant running for a month, because you know even if there is a transportation disruption, you can acquire them, then if you're keeping 2 months' worth of inventory, at the margin, the yield is very, very low for those additional stocks. So as we add stocks, this marginal convenience yield will fall, which means the return associated with holding the inventory actually falls. So now we have the 3 components of the marginal cost. So this is number 1, this is number 2, and this is number 3, right? And if we stack these up on top of one another, So for a low level of stocks, we have small physical costs, we have small risk aversion, and we have high convenience yield. Convenience yield is negative. So we have low physical, low risk, and high convenience. So we add 1, 2, and 3, and we end up with 4, right? The reason that 4 is below the horizontal zero intercept is because it picks up this very high convenience yield, right? So if we add 5, 6, and 7, well, now we have a low convenience yield, so it doesn't really factor in. 5 and 6 are pretty high, right? So we end up out here with 8. So that picks up the high risk factor, the high physical costs, and the very low convenience yield. Hence we get this funny shaped supply curve. And this is the supply of stocks that entrepreneurs are willing to carry forward. And we can find the level supplied by looking at the price spread. Even if the price spread is negative, some stocks will be carried forward. What is the term we use in the futures market when the spread is negative? Remember, we talked about this, I think, a week ago. If you look at July wheat and the price is $3.50, you look at September wheat and the price is $3.25. July, $3.50. September, $3.25. What's the term we use to describe that relationship? Yes, sir. Thank you. Inverted market, inverted carrying charge. That's unusual, right? Normally, we see July at $3.50. We see September at $3.75. See December at $4. Normally we have a positive carrying charge because it costs money to carry stocks. But sometimes we see an inverted market. It's back here. That explains why periodically we'll see inverted markets, because we're at the low end of the supply curve where some firms are actually willing to carry supplies even though the price of storage is negative, right? If you bought July and sold September, you can't lock in a profit. The market's saying do not store. There's a negative price for storage. The market is not paying you to store. So why would you store? Well, because I get convenience yield. That's why. Just like the market doesn't pay you to carry money around your pocket because you're not earning any interest on it. You're actually losing. So it seems a bit irrational, but you get some convenience yield. So we bring the two together, our supply curve and our demand curve, and that gives us this equilibrium in the marketplace that Working referred to. So again, to repeat his theory, what he was saying was, when we look at intertemporal prices, the price between different futures months, or even if we include the spot price, we can put the spot price in there. Spot's at $3. If we look at these price spreads, okay, this is 50 cents, this is minus 25. He said you can explain that by the supply and demand for storage. It's where they intersect. If the intersection is out here, the demand has shifted way right, well then the price spread is going to be very large. As the demand shifts back to the left, then the spread is going to narrow, and it could even become negative, right? This situation here, where we have the inverted market, Well, the demand must be sitting back here. The supply curve doesn't change that much. It's pretty stable. It changes a little bit as interest rates change and so on, but not dramatically. So the demand curve is shifting back and forth. That gives us the different price spreads. Okay. Any questions on the supply and demand of storage? All right. You say them for Montisha? Thursday night before the exam. Okay. I just want to say one more thing before I jump to Chapter 4. I mentioned on Wednesday this term called the basis. And we'll get into the basis once we discuss hedging in great detail, but I'll just introduce it again. Basically, that's the difference between the cash price and the futures price. And if we have the cash price or the spot price for the same delivery location as specified in the futures contract, and remember I talked about that, right? There's the futures contract specifies a delivery point. If it's crude oil, the delivery point's in Oklahoma. Well, there's also a spot market for oil in Oklahoma. And you would expect that if we look at June futures for oil and spot oil in Oklahoma today, it would look something like this. June futures ought to be above spot because it costs money to carry oil from now until June. As we approach June, those two will converge. We get into the month of June, the spot price for oil in Oklahoma and the futures price for June delivery will become very similar, almost identical. They come together, which means that the basis narrows. So the basis is somewhat predictable over time for certain spot markets. For the spot market that's the same as the delivery point for the futures contract, in the delivery month, the basis approaches zero. Okay? Here's a graph of an actual basis level in the, I think this is, the corn market. This is the corn market. And up here, this is the futures price, the dashed line, and this is the Illinois cash, the Illinois cash price. So the futures contract for corn specifies delivery in Illinois. Chicago's in Illinois. I guess you Cub fans know that, right? So if we chart the Illinois cash over time against a futures contract, this was a December contract, it started out with the cash well below the DC contract. Then as we approach maturity, you see they start to come together. And I've charted the basis down here. And the basis falls. It started at 70 cents a bushel and then gradually fell. So in a market like that, Illinois cash, Chicago corn, well-functioning market, it behaves pretty much the way the theory says. As we approach maturity, the spot and the futures market come together. Okay? So I'm going to roll the tape, keep an eye on Jim, and pay attention to factors that affect currencies. I might ask you this next Friday. And you should know it anyway if you're trading currencies. In this film, they tell you which economic variables affect the currency market. Why is the US dollar falling today? Why is the Canadian dollar rising? Why is the euro rising?
Strengthened against the peso and Canadian dollar. Trade figures improved last month. The French franc closed down against other currencies. movements in the Swiss franc.
Wow, is there a lot going on out there or what? I'm not just talking about out there, but out there. Welcome to the show. I'm your host, and answering your questions is what we're all about. Today we've got something very exciting, current, global, trading foreign currency futures. What's it all about? Is it for you? That's what we're going to be getting into. Did I miss anything, Fran? Everybody, Fran, my producer.
Expert?
Oh, that's right. I'll be leaving the tough stuff on this show to experts. And have we got them? A financial analyst, a currency trader, currency brokers, David Lerman, our guest expert from the Chicago Mercantile Exchange, and finally, a very exciting surprise guest, a celebrity in financial circles. And I'm not going to tell you another word. So, let's go. Let's explore. Onward. When I tell you that people are asking about foreign currencies, I'm not kidding. Oh, here's a letter from Chuck. He's a West Coast entrepreneur. I used to be an entrepreneur. Chuck asks, what is the foreign exchange market and why should I care? That's nice. I like that, Chuck. Cutting right to the chase. There's no drink, no date, no kiss at the door. Let's go boom, right to the point. Well, Chuck, I guess I've crossed a few foreign borders in my life. Let's see if I can get us started here. Currency, a medium of exchange. Every country's got its own. The dollar, Deutschmark, the Japanese yen, the Mexican peso, scratch, moolah, whatever you want to call it. Anyway, paper and coins. They're really nothing more than articles of faith. That's all it is, folks. Their value is relative. Currency prices reflect how the markets perceive one country's economic and political strength versus the others. That's why you'll hear the dollar quoted as so many yen or marks or Swiss francs. It's a comparison. It's a vote of confidence or no confidence. Stronger, weaker, yin, yang, tomato, tomato. Let's call the whole thing off. And the values can change from minute to minute, 24 hours a day. Okay, so back to Chuck's question. What are the currency markets? Let's turn to the superhighway. My little window to the world is here to help us out. Currency markets. Let's see what comes up.
We use dollars to buy stuff. People in Japan use yen to buy stuff. If we want to create a transaction between Japan and the United States, we have to use each other's currencies and we have to price them, and that becomes what is commonly known as foreign exchange market.
Budget deficits, balanced budgets, new parties in power. You have all kinds of news and information that can affect these markets.
It is probably the biggest single market on the planet today. It has tremendous liquidity and tremendous participation of opinion of price and value from people throughout the world. That's what makes it so exciting to trade.
Oh, thanks, Fran. When governments make decisions, the markets react. Exchange rates rise and fall as traders around the world cast votes of confidence or no confidence in currencies and, in effect, countries.
I think Chuck, the West Coast entrepreneur, wanted to know why he should care.
Oh, well, that's right. Well, there's profit potential here, Frank, and we'll get to that in a moment. Anyway, activity in the foreign exchange markets is not distant, esoteric stuff. It impacts on our lives every day. Let me show you. I love this car. But if the dollar's weak versus the Deutschmark, you'll pay more for it. Now, if you're thinking, hey, I pay dollars, where does the exchange come in? Well, BMW will eventually sell your dollars to buy Deutschmarks to pay their bills. That exchange rate's reflected in the price you pay. You'll pack in a lot more vacation if the dollar's strong versus the currency of the country you're visiting. A dramatic currency drop might mean you can stay 2 weeks for the price of one. Say you have $10,000 in a mutual fund and 10% of that fund's assets are in another country. You have $1,000 in currency exposure. You're already in the currency markets. That's because to buy foreign stock, you've got to use local currency. The currency is exchanged back for dollars when you take your profit. As you can see, currencies do affect us. Next question. Fran tells me we have a physician in Boise, Idaho. Okay. Hello, Boise.
Hi. You know, I'm pretty comfortable trading stocks and bonds.
International or domestic?
Mostly U.S. The performance doesn't always burn up the tracks, but what I'm wondering is, are there any good reasons why I should venture out into trading currencies? Uh-oh, my pager. Gotta go.
Oh, thanks for calling. The doctor on the run raises some intriguing questions. Is there opportunity beyond the U.S., beyond stocks and bonds? Frank, could it be time for? Do you feel it? Yes, I do too. Yes. Okay, let's ask David. David Lerman, the go-to guy for the Chicago Mercantile Exchange. David, how you doing?
Good to be here.
You comfortable? So, what can you tell the busy doctor in Boise?
Well, clearly man, in this case woman, does not live by stocks and bonds alone. Currencies are a great way to diversify a portfolio. These are very exciting times, very exciting markets, and trading foreign exchange is something that can be done by anyone with the capital and the drive to do it. Of course, it's not for everybody, but then again, I know your viewers aren't just anybody.
David, you recently spoke to world-class investor Jim Rogers about currencies and trading currency futures?
I did, and this is one interesting guy. Jim Rogers made millions on Wall Street. Now he's a private investor and teaches finance at Columbia University School of Business. He even motorcycled around the world 65,000 miles, crossing 50 or 60 foreign borders. The man knows currencies cold.
He probably knows saddle sword, too.
Jim does not live life from his easy chair. He's traversed the world, the Sahara, Red Square, there he is in Beijing. It's given him a pretty comprehensive view of the world, I'd say.
Okay, well, let's look at some excerpts from your conversation. Fran, can you roll that tape?
You travel around the world, open air on a motorcycle. Has any of this impacted the way you look at the currency market, to trade the currency market?
We exchange currencies everywhere. Black markets, state banks, private banks, just about everywhere. The currencies and their fluctuations are incredibly important to everybody in the world, whether you live in Iowa or whether you live in Zaire. The currency, David, is like a thermometer. It tells you what's going on in a country, how well a country is being managed, how well an economy is being managed. If you can only look at one thing, look at the currency. And that's where you should start.
If you look at some of the successful investors of the world, they seem to diversify beyond stocks and bonds. Why should you do it?
You read in the front page of the newspapers every day, dollar hits new lows, currency's moving around. You can get involved. In the world we're coming into in the next 5 years, the next 10 years, the currency movements are going to be dramatic. That's going to be the market of the future. That's why every American should learn about currencies and start learning to trade them.
So what do you think turns new participants onto this market?
It's intellectually challenging. There's nothing more exciting because with currencies, you've got to understand it all. You've got to understand this whole big world. My knowledge of currencies and how they move and have affected world trade and world economies throughout the last 30 years, that's probably been the single most important thing that's helped me have whatever success I've had.
So when you do trade currency futures, what do you look at? How much is based on gut? How much is actually based on study or looking at charts or looking at tables or whatever?
The successful trades are the ones based on study, based on a lot of knowledge, and based on standing back and saying, okay, this is what's going to happen. The unsuccessful trades are the ones based on guts. When my emotion gets involved, I nearly always get it wrong.
What can an investor study to get a grasp on the currency markets?
Wall Street Journal, Barron's, the Financial Times, The Economist, there are lots of things that you can read. Those are basic things which I read all the time, to read about what's going on in the world and how those things might affect the currency.
Many people in the world refer to you as a world-class investor. They would love to have a fraction of your success. Is there a couple of tips that you can share with the Jim Rogers wannabes out there?
Two things, buy low and sell high. But more important than that, David, don't do anything until you've done your homework.
What kind of reward can someone expect from currency trading?
The movements in the currency markets in the future are going to be much bigger than the movements in the stock market, much bigger than the movements in the bond market, much bigger than in most commodity markets. So this is where the big plays are going to be in the future. And if you get it right in the currency markets, that's where the great fortunes are going to be made in the next decade.
You know, it sounds like it's a good time to pay attention to currencies.
We're becoming a much more integrated, interdependent world, a global village, as it were.
Think about it. Big Macs. If you've traveled, you know, thank you. You know, you can find these just about anywhere. Let's see how your dollar would do buying this familiar meal in 3 different countries between June '94 and January '95. So in Mexico, you can pay the equivalent of $2.39 in June, but $1.22 6 months later in January. In Japan, $3.96 in June, $4.49 in January. And in Germany, $2.92 in June, $3.37 in January. David, tell us what this means.
It's pretty simple. In that 6-month period, the dollar grew stronger against the peso and weaker against the yen and the D-mark. So it took fewer dollars to buy a burger in Acapulco and more to buy one in Munich and Tokyo. Movements like that may mean lunch money for most people, but for people trading currencies, they mean opportunity.
Frank, could you, thanks. I'll, lunch later. So, let's take a call, shall we? This one is from, Hamburg, Germany. Dieter, are you there with us?
Yeah, I have a question. If the currency markets are so big, exciting, and full of potential, I want to trade them. How do I do it?
Dieter, excellent question. David.
Dieter, what you need to participate in the currency futures market are two things: an opinion about a currency's direction and money. Currencies represent a $1 trillion a day market. A lot of activity takes place in what's called the cash market. That's where huge deals are transacted directly between two parties, typically banks and corporations, to facilitate international trade. Now, the futures market, here's an excellent place for institutions and individuals. It's a regulated marketplace. It has safeguards, and opinions of traders large and small are represented. It's fair, it's level, and it's open.
Sounds like a great place to raise kids. It also sounds like the futures market's the best place for a Dieter to get involved.
That's right.
Okay, let's see what else we have here.
There are advantages to trade currencies in the futures markets. Firstly, it gives an individual access to a huge global market that he would definitely not have unless he did trade on an exchange. In the cash market, the size of the positions would have to be so large it would not be possible for an individual to do it. On an exchange, in the regulated futures contracts, it definitely is accessible.
There is no counterparty risk by trading on an exchange. The clearinghouse guarantees the performance of every single position to every participant.
You don't need a very big move to profit. And really, that's what makes trading in all futures markets worthwhile.
Leverage has been a hallmark of some of the greatest fortunes made throughout the world. And leverage is affordable to the average person on the Chicago Mercantile Exchange and other futures exchanges in the United States.
Leverage is your definite friend, but it can be a worst enemy if you don't know how to respect it.
The advantage, of course, of being in the futures markets is they are so liquid that if you're wrong, you can get out quickly.
Liquidity, leverage, lots of activity.
Yeah, these are great markets, and although you need capital, you don't need a fortune to get started.
Okay, it's time for another call. This one's from the Pacific Rim. Hello, Dennis. You're a business executive living in Japan. Dennis, you are up late.
Yes, it's tomorrow here already. I just got your video in the mail, and I have a question.
You just got this video in the mail?
Right.
The one that's being taped even as we speak?
Right.
Okay, then, so you can see me wave?
Yes. Now, could you please answer my question?
Sure, fire away. Go ahead.
Good. What I want to know is, what are some of the factors that affect foreign currency markets? I mean, what makes them move? I see lots of information in the paper, on TV, I hear stuff on the radio, but what has the biggest influence on the markets?
Dennis, you've just asked the $1 million question.
That's 86 million yen, 1.4 million Deutschmarks, 7 million pesos.
Easy, Dave. Whoa, boy, easy. Dennis, you seem to have access to greater powers than most of us, but really, no one knows exactly what most impacts the markets. Right, David?
There is no crystal ball. Every trader has a different way of forming his or her opinion. You don't have to be a Harvard MBA to trade foreign currency futures, but there are factors to consider. Here's a few of them. Interest rates. Money tends to flow where it gets the best rate of return. Inflation. Inflation erodes the purchasing power of a currency, and why would anyone purchase anything of eroding value except perhaps a car? Monetary policy. What are the central banks doing? Tightening money supply, or are they loosening money supply? Trade balance is very important. Are we exporting or importing more? How much beef do we send out versus VCRs do we bring in? When imports exceed exports, that puts pressure on a currency. Economic growth. Where is the country in its business cycle? In recession? In recovery? Political stability is also important. Is there a civil unrest? A leadership change? Are there strikes? In general, the more stable the political system, the more attractive the currency.
Oh, all right, this just in. Oh, a fax from Susan in St. Louis. She asks, is there any way to know when to get in or out of a market?
Two answers, yes and no.
Firm answer, I like that. That's good.
That's helpful, isn't it? Let's assume you formed an opinion about a particular currency's movement. You've looked at factors, the fundamentals. Now you might want to look at what the markets can tell you. You're looking for price trends, and you can use charts to do it.
Frank, can we see the chart?
You might want to check the relative highs and lows for a currency. Let's say for the yen, for the last several months or years or a couple of days, I've drawn trend lines on these charts, connecting the higher highs and higher lows, trying to identify a trend. If we break substantially above or below the lines, it might signal that a trend is changing.
So charts help us identify trends. What then?
Choose a course of action. You want to buy futures or go long when you anticipate an uptrend. You want to sell futures or go short when you think the market will trend lower. Getting that right is the challenge. You can use both fundamentals, the economic factors, and technicals, things like charts to help you decide when to enter or exit the market.
Okay, I got that, good. But Dave, there's something else I want to ask you. I was checking out the journal this morning, and I'm thinking, what am I seeing double here? There's currency quotes right on this page and on this page, and they're not the same.
Currencies are quoted in two ways. Most common you'll hear on the radio or TV, something like the D-Mark closed in London today at 1.4 D-Marks per dollar. That's a cash market quote. It quotes currency per dollar. When you see a currency futures quote, it'll be just the opposite, dollars per currency. Like the D-Mark is at 72 or 72 cents to the D-Mark.
Okay, what happens if you hear the cash market quote on the radio, but you want the other one, the futures quote?
It's simple. To get the futures quote, just divide 1 by the cash quote. In this case, 1 divided by 1.4 D-Marks. That gives you
0.72. So 72 cents buys you 1 D-Mark.
You got it. Here's a simple rule that'll cover you either way. Just divide 1 by the quote you have to get the other.
David, that's great. You've enlightened us today. So I just want to thank you very much. I know you have to go, but thanks for coming by.
Pleasure's mine.
David Lehrman, everyone. Smart guy. Well, we're on our own again, aren't we, Fran? Oh, there's another call I see from Bob, trading currencies from his home in Iditarod, Alaska. Bob, can you call off the dogs?
Oh, sure. Girls, shh. You know, I just started trading, and I love it, but I really don't get to talk to many other traders up here, so I'm not sure if this is a common problem or not. You know, when things are going right, I feel great, but when they turn around, I have a hard time admitting that I'm wrong. Does anyone else experience this?
Bob, this might be an ego thing. Let me check this here. I'm not saying you're alone. My computer's down. I don't know. Fran, are there any other experts on this? Is there anything we can pull in here?
It's like this. You buy D-Marks at 66.25, and they're down at 66. You just lost 25 ticks. That's around $300. The market's going against you. You can't have an ego problem and say, I'm a bright guy with the Wharton MBA. This market's going to turn around. I mean, sometimes you just got to take a loss. So take it. Check your ego at the door. There's a checker there. He'll give you a ticket.
Fred, do you need a moment? Let me just try this computer again. Oh, we're back online. So let's check ego. See, risk management. Yeah.
The key is to avoid the emotional ups and downs in trying to make decisions in a moment of high emotional activity. We find that most trading decisions should be made before the market opens and orders placed accordingly.
You must have a plan. You must have an idea of where you expect that market to go, when you expect it to go there, and how you expect it to get there.
Before you get into the market, you should know where you will get out.
Just have a rule. I'll risk X dollars per trade. If it goes through that, I'm wrong.
Risk not thy whole wad.
You make money in any market by limiting your losses and letting your profits run.
Just keeping it all in perspective. That's the key. Special delivery. Oh, you want me to sign? Does want to sign? I don't want to sign. Let's see what this is here. Oh, it's a note from Frank down the street and around the block. It says, your phone was busy. I'd really like to trade foreign currencies. What do I look for in a broker? I can't answer that for you, Frank. I don't have a broker. But you know, if I did, I would call him right now. Well, seems that Frank has a broker. Thank you, Fran. We're going to call Fran's broker right now. Yeah, when did you get broker? Here we go. We're gonna learn some stuff about brokers right now. We'll be right back. Broker, huh?
Well, a good broker should get to know what the client's objectives are, what the amount of working capital is, what levels of risk the client is comfortable.
If you trade futures contracts, trade with someone who exclusively trades futures contracts.
I recommend that you get in touch with a good broker who can definitely give you a lot of assistance daily.
He can tell you where the market is from moment to moment, hour to hour, day to day.
You may have another job. You can't watch the markets all day. And you can say to him, hey, if the market gets to here, can you give me a call, please?
Hi. Franz, broker, please. Oh, you are? Oh, well, I'm calling about currency futures trading. Yeah, I do know a few things about it. Well, there's certainly more I need to, can you hold on a second? Thanks, everybody, for watching. Was this a great show or what? Until next time, be good. My goals? Well, I'd like to host the annual awards someday. Oh, my investment goals, yeah. Oh, sure.